So, what's up everyone, Aniket here, and welcome to the SAP Simplified channel. Today, we're kicking off a brand new series, and this one is for everyone out there grinding, getting ready to take that next big step in their career. We're going to be deep diving into the world of SAP Materials Management, or as you know it, SAP MM. We'll be breaking down some of the most critical, most frequently asked, and frankly most important interview questions that you're likely to face. The goal here is simple, to equip you with the knowledge, the confidence, and the precise answers you need to not just get through the interview, but to actually impress the hiring manager and land that dream job in the SAP space. This video, and the series that follows, is specifically designed for all you SAP job seekers. Whether you're a recent graduate just stepping into the ecosystem, a consultant with a few years under your belt looking to switch companies, or even an experienced professional aiming for a senior role, this is for you. We're going to move beyond simple definitions and textbook answers. We'll explore the why behind the what, giving you a more profound understanding that will help you articulate your points with clarity and authority. Think of this as your personal interview prep bootcamp, a guide to navigating the technical questions that often separate a good candidate from a great one. We're covering the fundamentals, the advanced topics, and everything in between. The structure for today is going to be super straightforward. We'll tackle each question one by one, dedicating a chapter to it. I'll start by explaining the core concept in a way that's easy to digest, breaking down complex jargon into simple, understandable terms. Then we'll expand on it, adding layers of detail, discussing its significance within the broader SAP landscape, and touching upon the practical implications in a real-world business environment. My aim is to give you a complete 360-degree view of each topic, so you're prepared for any follow-up questions they might throw your way. It's not just about memorizing answers, it's about genuinely understanding the material from the ground up. So, grab a notebook, maybe a cup of coffee, and get ready to level up your SAP MM knowledge. We're starting with the absolute basics and building a solid foundation before moving on to more complex scenarios. By the end of this session, you'll have a much clearer picture of what interviewers are looking for and how to frame your responses effectively. This is your chance to really sharpen your skills and walk into that interview room feeling prepared and confident. Let's get right into it, starting with the most fundamental question of all: what is SAP MM? Let's begin. Alright, let's dive into our very first question, and it's the foundational one. What exactly is SAP MM? So, at its core, SAP MM stands for Materials Management. It's one of the key modules within the larger SAP ERP Central Component, or ECC system. Think of a massive, complex organization, a manufacturing company, a retailer, anything that deals with physical goods. This organization needs a robust system to handle every single aspect of its materials, from the moment a need is identified to the point where materials are used and paid for. That's precisely where SAP MM comes in. It's the central nervous system for everything related to a company's supply chain and procurement logistics. It ensures that the right materials are in the right place, at the right time, and at the right cost. So when an interviewer asks this, they're looking for more than just the full form. They want to see if you understand its role in the big picture. SAP MM is fundamentally a component that integrates deeply with a whole suite of other SAP modules. For example, it connects with SAP Finance and Controlling, or FICO, for posting invoices and managing payments. It links up with Sales and Distribution, or SD, to understand sales demand, which drives procurement needs. It works hand in hand with Production Planning, or PP, to ensure raw materials are available for manufacturing schedules. This integration is the magic of SAP. It creates a seamless flow of information across the entire business, eliminating data silos and enabling real-time decision-making. Let's break down its purpose even further. The primary function of materials management is to manage the procurement process and the inventory of a company. This entire life cycle is often called procure to pay. It begins with planning what materials are needed, creating purchase requests, sending those orders to vendors, receiving the goods into inventory, and finally, verifying the invoices and paying the supplier. Every single one of these steps is managed, tracked, and optimized within the SAP MM module. It provides businesses with the tools to handle their supply chain efficiently, reduce procurement costs, maintain optimal inventory levels, and build strong relationships with their vendors. It's not just an administrative tool, it's a strategic one. So a great answer would summarize it like this. SAP MM is a critical functional module in the SAP ERP system that provides comprehensive management of materials, inventory, and the entire procurement process. It's the backbone of a company's logistics, ensuring a smooth and uninterrupted supply chain from procurement to consumption. You should also highlight its tight integration with other modules like SD, PP, and FICO, as this demonstrates your understanding of how it fits within the broader enterprise structure. It's this end-to-end management and cross-functional integration that makes SAP MM so powerful and indispensable for businesses that rely on a steady flow of materials to operate and succeed. Moving on to the next logical question, what are the main components of SAP MM? If SAP MM is the engine, then these components are its critical parts, each with a specific and vital function. An interviewer asks this to gauge the depth of your knowledge. They want to see if you can break down the module into its constituent parts and explain what each one does. The first and perhaps most central component is purchasing, often referred to as per. This submodule handles all the activities related to procuring goods and services from external vendors. It's where you manage purchase requisitions, purchase orders, requests for quotations, RFQs, and contracts. It's the transactional heart of procurement. The second major component you need to talk about is inventory management, or IM. Once you've purchased the materials, you need to manage them, and that's what inventory management is all about. This component deals with the planning, entry, and documentation of all goods movements within the company. This includes critical processes like goods receipts, goods issues when they are sent to a production line, and stock transfers when they are moved between different storage locations or plants. It provides a real-time, accurate picture of the company's stock levels, which is crucial for preventing shortages or overstocking. And it's the foundation for accurate financial accounting of inventory. Next up, we have a component that works very closely with inventory management, and that is physical inventory. This part of SAP MM is dedicated to the process of physically counting the company's stock. While inventory management tracks stock digitally, physical inventory handles the procedures to ensure that the system data matches the actual physical reality in the warehouse. This involves creating inventory documents, entering the count results, and posting any differences. It's an essential process for maintaining data accuracy and is a key part of financial compliance and auditing, ensuring the value of the inventory on the balance sheet is correct. It's all about reconciling the digital world with the physical one. Finally, you have two more critical components to mention. The first is logistics invoice verification, or LIV. This is the last step in the procurement chain. After receiving the goods, the company receives an invoice from the vendor. The LIV component is used to check that this invoice is correct in terms of quantities, prices, and terms before it's sent to accounting for payment. It links the purchase order and the goods receipt to the invoice, creating a three-way match that prevents errors and fraud. And the second one is material master data, which isn't a transactional component, but the central repository of information for every material. It contains all the data, purchasing data, storage data, accounting data, that the system needs to process any transaction involving that material. Alright, so let's dive into the third question you're almost guaranteed to get. What is a purchase requisition? Now, on the surface, it sounds super formal, maybe a little intimidating, but the concept itself is actually pretty intuitive. Think of it like this. You're working in a big company, maybe on the assembly line or in an office, and you realize you're running low on something essential. It could be a specific type of screw for a product, a box of A4 paper for the printer, or even a new ergonomic chair. You can't just run to the store or pull out a company credit card. There's a process for this, a formal way to signal a need, and that's exactly what a purchase requisition is. It's the very first step in the procurement workflow, an internal non-binding document that essentially says, hey, purchasing department, we need this stuff. So, a purchase requisition, or PR as you'll hear it called all the time, is basically an internal request. It's not a contract, it's not an order, and it has zero financial obligation to any outside supplier at this stage. It's purely a communication tool within the organization. The main purpose is to give the purchasing department a heads up and provide them with all the necessary details to go out and procure the goods or services. This document officially kicks off the procurement cycle. It's the spark that lights the fire. Without a PR, in a properly configured SAP system, the purchasing team wouldn't even know that a need exists somewhere in the company, which is key for maintaining control and visibility over spending. It's the system's way of creating an official, trackable record of a need from the moment it's identified. This document is more than just a simple note, though. It contains some pretty critical information that the purchasing team will rely on. We're talking about a detailed description of the material or service needed, the exact quantity required, the desired delivery date, and potentially even a suggested vendor if the requester has one in mind. It also includes information like the cost center that the purchase should be charged to, ensuring financial accountability from the get-go. This level of detail is what makes it so powerful. It minimizes back and forth communication and potential errors down the line. It's a standardized format for a request, which is crucial for efficiency in a large organization. Ultimately, the purpose of the purchase requisition is to centralize and control the procurement process. It prevents what's known as maverick buying, where different departments just go out and buy things on their own, leading to inconsistent pricing, unvetted suppliers, and a total lack of spending oversight. By channeling all requests through this single formal document within SAP MM, a company ensures that every purchase is authorized, budgeted for, and strategically sourced by the professionals in the purchasing department. It's the foundational layer of an organized, efficient, and cost-effective supply chain. It's the gatekeeper, making sure every need is validated before it becomes an actual purchase. Okay, so building directly on that, let's talk about the next logical step and our fourth interview question: what is a purchase order? If the purchase requisition was the internal request, the ask, then the purchase order, or PO, is the official external commitment. This is where things get real. A purchase order is a legally binding document that a company sends to a vendor or supplier. It's the formal confirmation of an order for specific goods or services. Once the vendor accepts the PO, you have a contract. It outlines all the agreed-upon terms and conditions, effectively saying, "We officially want to buy these items at this price, delivered by this date." It's the document that turns a need into a commercial transaction. So, how does it get created? Well, in the standard workflow, a purchase order is typically created with reference to a purchase requisition. The purchasing department takes that approved internal request, analyzes it, finds the best source of supply, whether that's a pre-negotiated contract or through a competitive bidding process, and then converts that information into a formal PO. This document is then transmitted to the chosen vendor. It's the official green light for the supplier to go ahead and ship the goods or begin performing the service. It's a critical piece of the puzzle because it formalizes the entire agreement and leaves very little room for ambiguity between the buyer and the seller. Now, let's get into the details, because a PO is packed with essential information. It goes beyond the PR and includes specifics that are legally enforceable. You'll find the vendor's name and address, the precise material numbers, quantities, and descriptions. But crucially, it also includes the negotiated price per unit, the total order value, payment terms like net 30, the delivery address, the ship to location, shipping terms, and any other specific legal clauses or conditions that both parties have agreed to. This document becomes the single source of truth for the transaction, referenced during goods receipt, invoice verification, and for resolving any potential disputes later on. The core function of the purchase order in SAP MM is to provide a comprehensive and legally sound framework for a purchase. It serves as an official record for auditing purposes and is essential for financial planning and budget tracking. It allows the company to commit funds for the purchase and track the order's status from creation all the way through to final payment. For the vendor, it's their authorization to proceed and their guarantee of payment, assuming they meet all the conditions laid out in the document. So in short, the PO is the cornerstone of the purchasing process, the formal handshake that makes business happen. So, this brings us to a super common follow-up question, and it's a really important one for checking your understanding. What is the difference between a purchase requisition and a purchase order? It sounds simple, but articulating the distinction clearly is key. The most fundamental difference lies in their nature and audience. A purchase requisition is an internal document. It's a conversation happening inside the company from one department to the purchasing department. It has no legal standing and creates no obligation with any external party. It's simply a formal request, a wish list with details. It's a "may we please buy this" document. It's the starting point, the signal of a need. A purchase order, on the other hand, is an external document. This is the company speaking to the outside world, specifically to a vendor. It is a formal, legally binding contract, assuming it's accepted by the supplier. This document represents a firm commitment to buy. It's not a request anymore. It's an instruction. Think of it this way. The PR is like writing a grocery list for yourself before you leave the house. The PO is like going to the cashier at the grocery store and agreeing to pay for the items in your cart. One is an intention, the other is a transaction. This internal versus external distinction is probably the clearest and most important difference to highlight. Another key difference is the information they contain and who creates them. A purchase requisition can be created by almost anyone in the organization who has the proper authorization in SAP. An engineer on the factory floor, an office manager, a lab technician. It contains the details of what is needed from their perspective. A purchase order, however, is created almost exclusively by the purchasing department. These are the procurement professionals who take the PR, determine the best source of supply, negotiate pricing and terms, and then formalize it into a PO. The PO will contain additional, commercially sensitive information that the original requester might not even know, like the final negotiated price, specific contract numbers, and binding payment terms. Finally, let's talk about the workflow and purpose. A PR's primary purpose is to trigger the procurement process and to seek approval for an expenditure. It goes through an internal approval process, often called a release strategy, to ensure the need is valid and fits within the budget. Once approved, its job is essentially done. The PO's purpose is to execute the purchase. It communicates the official order to the vendor and becomes the primary reference document for the rest of the procure-to-pay cycle, for tracking the delivery, receiving the goods, and verifying the invoice for payment. So the PR is about authorization, while the PO is about execution. One is the question, the other is the legally binding answer. Alright, so let's talk about the goods receipt. This is one of those steps in the supply chain that might sound a little, I don't know, mundane. But honestly, this is where the digital world meets the physical world, and getting it right is super critical. So, what is it? At its core, a goods receipt is the formal process of confirming that the goods you ordered have actually arrived. It's the moment your company physically takes possession of the items from a vendor. Think of it like signing for a package you've been waiting for, but on a much larger and more system-integrated scale. This isn't just a simple checkmark. It's a key transaction in SAP that triggers a whole cascade of events within the system, updating everything from inventory levels to financial records. It's the official handshake that says, yes, we got it. Now, the importance of this step really can't be overstated. Imagine you've ordered 1,000 high-spec processors for your next product line. Without a proper goods receipt process, you're basically flying blind. Your inventory system wouldn't know they've arrived, meaning your production planning would be completely off. Your finance team wouldn't have a trigger to know that a payment might soon be due. So, the goods receipt serves as the definitive proof of delivery. It's the system's source of truth for what materials are physically on hand and available for use. This single transaction updates the stock quantity in your inventory management module, and, depending on the configuration, it can also update the stock value in your financial accounting system. It's a linchpin. So, what actually happens inside SAP when you post a goods receipt? When the warehouse clerk enters the transaction, typically using the MIGO transaction code, they reference the original purchase order. This is key because it links the physical delivery directly back to the initial procurement document. The system then compares the delivered quantity against the ordered quantity. Did they send what you asked for? Are the items correct? This is your first line of defense against shipping errors. Once you confirm the details and post the receipt, SAP automatically generates a material document, which is like the digital receipt for the transaction, and if the material is valuated, it also creates an accounting document to record the financial impact of the inventory increase. And this process is all about data integrity and visibility. By meticulously recording every goods receipt, a company maintains an accurate, real-time view of its inventory. This prevents stockouts, reduces the risk of overstocking, and ensures that the production lines have the materials they need, exactly when they need them. It also provides a clear audit trail. If there's ever a dispute with a vendor about whether something was delivered, you have the digital paper trail to prove it. So yeah, it might seem like a simple step, but the goods receipt is the foundational transaction that makes modern, efficient inventory management possible. It's a clean, elegant solution to a complex logistical problem. Okay, so after the goods have been received, there's one more major checkpoint before any money changes hands. And that brings us to invoice verification. So what is it? This is the process of checking the vendor's invoice to make sure it's accurate and matches what you actually ordered and received. It's the final step in the procurement cycle before the payment is processed by the accounts payable team. Think of it as the final boss of the P2P, procure-to-pay process. You're not just taking the vendor's word for it, you're systematically verifying every detail. The goal here is to catch any discrepancies in prices, quantities, or terms before you cut the check. It's all about protecting the company's cash and ensuring you only pay for what you legitimately owe. Now, this isn't just a manual eyeballing a piece of paper kind of thing. In SAP, invoice verification is a highly integrated process, typically handled using the Miro transaction code. The system performs what's called a three-way match, which is honestly a pretty elegant piece of system design. It compares three key documents: the purchase order, the goods receipt record, and the vendor's invoice. The purchase order tells you what you agreed to pay. The goods receipt tells you what you actually received. And the invoice tells you what the vendor is asking you to pay. If all three of these documents line up perfectly, same items, same quantities, same prices, then the invoice is cleared for payment. It's a clean, automated check for consistency. But what happens when they don't match? This is where the system really shows its value. If there's a discrepancy, say the invoice price is higher than the purchase order price, or the invoiced quantity is more than what was recorded in the goods receipt, SAP will block the invoice for payment. This creates a hard stop in the process, preventing an incorrect payment from going out the door. The system flags the variance, and it's then up to a person, usually in accounts payable or procurement, to investigate and resolve the issue. Maybe it was a simple data entry error, or maybe it requires a conversation with the vendor to get a corrected invoice. This blocking mechanism is a critical control for preventing overpayments and fraud. Ultimately, a robust invoice verification process is fundamental to good financial governance. It ensures that payments are timely and accurate, which is crucial for maintaining good relationships with your vendors. Nobody likes late or incorrect payments. It also provides a complete audit trail for every single purchase, from the initial request all the way to the final payment. This level of detail is invaluable for financial reporting, budgeting, and spend analysis. So while it might sound like just another administrative step, invoice verification is the final critical safeguard that ensures the integrity of the entire procurement process. It's the system doing the heavy lifting to make sure everything adds up exactly as it should. So, let's get into one of the absolute cornerstones of SAP MM and really, the entire SAP logistics system, the Material Master Record. What is it? Simply put, the Material Master is the central repository of information for every single material or service that a company procures, produces, stores, or sells. It's the single source of truth for a material. Think of any item your company deals with: a raw component like a screw, a semi-finished product like a circuit board, or a finished good like a smartphone. Each one has its own unique Material Master Record. This record contains all the data required to manage that item across different departments, from purchasing and inventory to sales and accounting. It's the digital DNA of a product. Now, the sheer amount of data held within a single material master record is pretty impressive. It's not just a name and a part number. The data is organized into different views, where each view corresponds to a specific business function. For example, the purchasing view contains information relevant to procurement like the default purchasing group, order units, and potential vendors. The MRP views, that's material requirements planning, hold data for production planning like how to procure the item and how much safety stock to keep. Then you have views for sales, for warehouse management, for quality management, and for accounting. Each department sees the data that's relevant to them all tied to one central record. It's a beautifully structured approach to data management. And this structure is what makes the whole system so powerful and integrated. Because all this information is centralized, any change made in one area is instantly available to all other relevant areas. When the engineering team updates a bill of materials, the planning team sees it. When the purchasing team negotiates a new price with a vendor, the accounting team has that data for invoice verification. This eliminates data redundancy and the inconsistencies that plague systems that rely on separate, disconnected spreadsheets or databases. Everyone is working from the same playbook, the same single source of truth. It ensures consistency and accuracy across the entire organization, which is a massive deal for any large company. So, creating and maintaining these material master records is a fundamentally important task. Key data fields you'll always find include the material number, the material description, the base unit of measure, like each or kilograms, and the valuation class which links the material to the financial accounting system. Getting this data right from the very beginning is critical because so many downstream processes depend on it. A mistake in the material master can cause a ripple effect of problems in purchasing, production, and sales. So yeah, the material master isn't just a record. It's the digital twin of a physical item, the central data object that makes the entire integrated logistics chain in SAP work. It's the foundation. All right, so let's talk about the vendor master record. If the material master is one side of the coin for everything you buy or manage, the vendor master is the other, equally critical side. This is essentially the digital Rolodex for every single supplier, contractor, or partner you do business with. It's not just a name and an address stored somewhere. It's a comprehensive, centralized database holding all the crucial information about your vendors. Think of it as the ultimate contact card, but supercharged for enterprise-level operations. Without this, you're basically flying blind, trying to manage relationships and transactions with scattered, inconsistent data, which in a system as integrated as SAP is a recipe for disaster. It's the single source of truth for who you buy from. So, what kind of data are we talking about here? It's broken down into 3 key segments, and this is important. First, you've got the general data. This is the top-level information that's consistent across the entire company. The vendor's name, their full address, communication details like phone numbers and email, bank details for payments, tax information, the fundamentals. This data is maintained centrally because, well, a vendor's name doesn't change just because a different department is buying from them. It ensures everyone in the organization is working with the exact same baseline information, which is key for consistency and avoiding duplicate, messy records that can cause major headaches down the line. Next up is the company code data. This layer gets more specific and is where the finance and accounting teams really live. This information is unique to each company code or legal entity within your organization. So if you have a US-based entity and a German-based entity buying from the same vendor, their company code data will be different. This includes things like payment terms. Maybe you pay them in 30 days in the US, but 60 days in Germany. It also includes the reconciliation account in the general ledger, which is super important for accountants to track payables accurately. This separation is what allows a global company to operate seamlessly with a single vendor while respecting local financial regulations and practices. Finally, we have the purchasing organization data. This is the domain of the procurement team. Just like the company code data, this is specific to the purchasing arm of your company that deals with this vendor. It defines the operational side of the relationship. What are the agreed upon Incoterms? Who is our main contact person in their sales department? What's the default currency we use for purchase orders with them? It might even include control data like whether goods receipt-based invoice verification is required. This level of detail ensures that every purchase order sent to that vendor is accurate, follows the negotiated terms, and keeps the procurement process running like a well-oiled machine. So, we've talked about a bunch of individual documents and records, but how do they all fit together? That's where the procurement cycle comes in. This isn't just a random sequence of events, it's a structured, logical workflow that takes you from realizing you need something all the way to paying the vendor for it. It's the core process that the entire SAP MM module is built around. Think of it as the complete story of a purchase, with each step being a chapter. The cycle, often called Procure to Pay or P2P, provides visibility, control, and efficiency. Following this cycle ensures that nothing gets missed, every step is documented, and there's a clear audit trail for every single transaction, which is a huge deal for compliance and financial accuracy. The cycle kicks off with what's called determination of requirements. This is the very beginning, the spark. It's the moment someone in the company, maybe on the production line or in an office, realizes they need something. This need is then formally captured in the system, typically as a purchase requisition. This isn't an order yet, it's an internal request. It's like adding an item to your Amazon wish list, not your shopping cart. This initial step is crucial because it's the formal starting point that triggers the entire procurement process. It allows managers to review and approve the need before any money is actually committed, providing a critical layer of budget control right from the get-go. Once the purchase requisition is approved, the purchasing department takes over. This next phase is source determination, where they figure out the best place to buy the required material or service. They might look at existing contracts, send out requests for quotation to multiple vendors, and evaluate the bids they receive based on price, quality, and delivery time. After selecting the best source, they create the official purchase order, or PO. This is the legally binding document sent to the vendor. It's the transition from an internal request to an external commitment. The PO contains all the specifics: what you're buying, how much, the price, and when you expect it to be delivered. After the PO is sent, we enter the monitoring and execution. You can't just send it and forget it. You monitor the PO to ensure the vendor will deliver on time. Then the big moment arrives, the goods receipt. The physical items show up at your warehouse or receipt point. You record this in SAP, confirming that you received what you ordered. This step is update your inventory levels in real time. The system now knows you have more stock. Following that, the vendor sends their order. Then where you meticulously check the invoice against the PO and the goods receipt to make sure you're not being overcharged. Finally, once everything matches up, the cycle concludes with payment processing, where your finance team pays the vendor, closing the loop on the entire transaction. Okay, let's dive into a concept that is, without a doubt, one of the absolute pillars of inventory management in SAP: the movement type. At its core, a movement type is a 3-digit code that tells the SAP system why your inventory is changing. It's not enough to just say, I have 10 more widgets. The system needs to know how and why. Did you receive them from a vendor? Did you find them during a physical count? Are you scrapping them because they're damaged? Each of these scenarios is a different movement, and each has a unique movement type. This simple code is the key that unlocks incredibly detailed tracking of every single piece of stock in your company. Think of it like this. Your inventory level is a number, say, 100 units. A transaction happens, and now it's 110. The movement type is the short story that explains that change. For instance, movement type 101 is one of the most common you'll see. It means goods receipt for purchase order. So when you use 101, SAP instantly knows that these 10 new units came from a specific vendor against a specific PO. It knows to increase the stock quantity and value. Conversely, movement type 201 means goods issue for a cost center. This tells the system you're consuming materials for internal use, so it decreases stock and posts the cost to a specific department's budget. It's this context that makes the data so powerful. The impact of the movement type goes way beyond just adding or subtracting from your stock count. It's a control key that dictates the entire back-end accounting process. When you use a specific movement type, SAP automatically determines which general ledger accounts to post the transaction to. For a goods receipt 101, it knows to debit the inventory account and credit the GRIR clearing account. For a scrapping 551, it knows to debit a scrap expense account and credit the inventory account. This automation is what ensures your inventory valuation and financial statements are always in sync and accurate, without an accountant having to manually figure it out for every single one of the thousands of daily stock movements. And the level of detail is just incredible. There are hundreds of standard movement types in SAP, each for a specific business scenario. There's 311 for transferring stock between two storage locations within the same plant. There's 102, which is the reverse of 101, used for returning goods to a vendor. There's 561 for initial stock uploads when you first go live with the system. This granularity is what gives companies precise control and visibility over their entire supply chain. So when you're asked about movement types, it's not just about knowing a few codes. It's about understanding that they are the engine driving all inventory management and its related financial postings in SAP. Alright, so let's dive into something that's really at the core of how a company understands its own money when it comes to inventory. We're talking about the valuation class. Now, on the surface, it might sound like just another piece of jargon, another field to fill out in the material master record. But it's so much more than that. Think of it as the financial DNA of a material. It's the key that links the logistical side of things, the actual physical material sitting in a warehouse, directly to the financial accounting side, the general ledger. It essentially tells the SAP system, hey, whenever this specific material is moved, bought, or sold, this is the exact set of GL accounts you need to update. Without this link, the system would be completely lost. So how does it actually work? Well, the valuation class is assigned to a material in its material master record, specifically in the accounting view. This isn't a one-size-fits-all situation, though. You group materials with similar financial characteristics together under the same valuation class. For example, all your raw materials might belong to one valuation class, all your semi-finished goods to another, and all your finished products to a third. This grouping is what makes the whole system so powerful and efficient. It allows accountants to manage a vast number of different materials without having to define accounting rules for every single one individually. It's a classic case of smart categorization, simplifying a complex process. The real magic happens during a goods movement. Imagine a goods receipt for raw materials. When that transaction is posted, the system looks at the material, finds its valuation class, and then uses a configuration table called the OBIC settings to determine which GL accounts to debit and credit. It's an automated process called automatic account determination, and the valuation class is the central pillar holding it all up. This ensures that the value of your inventory is always accurately reflected in your company's financial statements in real time. It's that seamless integration between MM and the finance and controlling, or FICO module, that makes SAP so robust for large enterprises. Ultimately, getting the valuation class right is non-negotiable for proper inventory valuation and financial reporting. If it's set up incorrectly, you'll see inventory values being posted to the wrong accounts, which can cause massive headaches for the finance team, especially during month-end or year-end closing. It's one of those foundational settings that you have to get right from the very beginning. So in an interview, explaining that you understand the valuation class is not just about defining a term, it's about showing you grasp the critical connection between physical inventory management and its financial implications, which is a huge part of what SAP MM is all about. Okay, let's talk about control and approvals. In any big organization, you can't just have anyone creating a multi-million-dollar purchase order and sending it out. There needs to be a system of checks and balances. And in SAP, that system is called a release strategy. Think of it as a digital automated approval workflow for your purchasing documents, like purchase requisitions and purchase orders. It's basically a set of rules that determines whether a document needs to be approved, who needs to approve it, and in what sequence. It's the gatekeeper that ensures purchasing activities align with company policies and budget constraints before any real money is committed. So, how do you set one up? The configuration is based on specific criteria or characteristics. For example, you could set up a release strategy that says any purchase order with a total value over $10,000 needs approval. Or maybe it's based on the material group. Like any IT hardware purchase requires a sign-off from the IT manager. You can even combine these. A purchase order over $50,000 for a specific plant might require a two-step approval. First the plant manager, then the regional director. The system checks the document against these predefined characteristics, and if it matches a strategy, it blocks the document from being processed further until it gets the necessary green lights. This process uses what are called release codes. Each approver or approval level is assigned a unique release code. When a document triggers a release strategy, the system assigns it a release status. Initially, it's blocked. As each person in the chain uses their unique release code to approve the document, the status gets updated. Only when the final person in the sequence approves it does the document become released. Once it's fully released, it can be processed further. For a purchase order, that means it can finally be printed and sent to the vendor. It creates a clear, auditable trail of who approved what and when, which is crucial for compliance and internal controls. So, in essence, the release strategy is a powerful tool for enforcing corporate governance within the procurement process. It prevents unauthorized spending, ensures adherence to budgets, and provides a structured workflow that is both efficient and secure. When you're asked about this in an interview, it's important to highlight not just the what, but the why. It's about demonstrating your understanding of business processes, financial control, and how to leverage SAP to enforce them. It shows you're thinking beyond just data entry and looking at the bigger picture of how a company manages its procurement cycle responsibly. Alright, so let's break down another key concept you'll definitely encounter: the difference between stock and non-stock procurement. On the surface, it sounds pretty straightforward, right? One goes into your inventory, the other doesn't. But the devil is, as always, in the details. And how SAP handles this distinction is crucial for a company's financial and operational efficiency. Think of it like this. When you buy a bunch of SSDs for future video edits, those are stock items. You're not using them all today, but you want them on hand, tracked in your inventory, ready to go. You care about how many you have, where they are, and what they're worth. That's the fundamental idea behind stock procurement. Now, let's dive deeper into stock procurement. When you create a purchase order for a stock item, you're not just buying a thing, you're acquiring an asset. The system knows this. It expects a goods receipt, a moment where you physically or systematically acknowledge, yes, this item is now in our possession. This action triggers a whole cascade of events in the background. It updates inventory levels, so your system now shows, say, 10 more units of that specific RAM module. Crucially, it also makes financial postings. The value of your inventory on the balance sheet actually increases. It's a tangible, trackable asset that the company owns and manages over time. On the flip side, we have non-stock procurement. This is for all the things a company needs to operate but doesn't necessarily want to keep on its books as inventory. Think about office supplies like pens, or maybe a one-time cleaning service for the studio. You're not going to create a material master record for a specific brand of whiteboard marker and track every single one. That would be overkill. For these items, the purchase order is essentially a direct charge to a cost center. You're expensing it immediately. When you procure a non-stock item, you're essentially saying, we need this for consumption, not for inventory. So, the key differentiator really comes down to accounting and inventory management. With non-stock items, the cost is typically assigned directly to a cost center or a project when you create the purchase order. The system isn't waiting to track its quantity or value in a warehouse. While you might still do a goods receipt for confirmation purposes, its primary role is to confirm the service was rendered or the item was received, not to add it to your inventory value. This simplifies the process for consumables and services, ensuring that your inventory records remain clean and only reflect materials that are truly part of your managed stock and production process. Okay, now we're getting into the deep end. This is for the power users, the consultants, the people who want to look under the hood. Let's talk about tables. In the world of SAP, everything, and I mean everything, lives in a database table. Knowing the key tables for the MM module is like knowing the keyboard shortcuts in Final Cut Pro. It's not just about showing off. It's about being faster, more efficient, and having a much deeper understanding of how data flows through the system. When you're troubleshooting an issue or building a custom report, you're not just clicking through screens, you're querying the source of truth directly from these tables. So let's start with the big ones, the absolute must-knows. First up, MARA. This is the big one for Material Master General data. Think of it as the passport for every material in your system. It contains data that is client-wide, meaning it's the same across all plants and storage locations, like the material number, description and base unit of measure. Then you have MARC, which is the plant data for a material. This table stores information specific to a particular plant, like the purchasing group or MRP controller. And to get even more granular, MARD holds the storage location data, telling you exactly how much stock you have in a specific spot. MARA MARD, that's the holy trinity of material data. Now let's move over to the purchasing side of things. When you create a purchase order, that information has to live somewhere. The header data, things like the vendor, document date, and purchasing organization, is stored in a table called ECHO. This is the purchase document header table. All the individual line items within that purchase order, like what material you're buying, the quantity, the price, and the delivery date, are stored in a separate table called ECHO, which stands for Purchase Document Item. Knowing the relationship between ECHO and ECPO is fundamental to understanding any purchasing process or report in SAP. Finally, let's talk about inventory movements. Every time a material moves, whether it's a goods receipt, a goods issue, or a transfer between locations, a material document is created. The header information for this document is stored in the MKPF table, but the real action is in the MSEG table, the document segment for material. This table is huge, and for good reason. It records the details of every single movement, the material, quantity, movement type, plant, and storage location. If you ever need to trace the history of a piece of inventory, MSEG is where you'll spend your time. It's the ultimate log file for everything that happens to your stock. So, there you have it. A pretty dense but, I hope, super useful rundown of some of the most common and critical SAP MM interview questions. We've covered a lot of ground, from the foundational concepts like purchase requisitions and purchase orders to the more technical details of valuation classes, release strategies, and even the core database tables that power the whole system. The goal here wasn't just to give you the answers, but to provide the context behind them, to help you understand the why and not just the what. Because in a real-world scenario, or in an interview, that deeper understanding is what really sets you apart. Remember, mastering SAP MM, or any complex system for that matter, is a marathon, not a sprint. It's about continuous learning and getting hands-on with the system whenever you can. Each of these topics could be a full video on its own, and maybe they will be. But for now, I hope this podcast-style format has given you a solid framework and a boost of confidence for your next interview or your next project. It's all about breaking down complexity into understandable pieces, and hopefully we've achieved that today. Keep digging, stay curious, and you'll get there. I really appreciate you sticking with me through all of that. It means a lot that you've invested your time here. If you found this video helpful, if it clarified even one concept for you or helped you prepare for an interview, then it's done its job. To help the channel grow and to make sure you don't miss out on future deep dives, please do me a huge favor and hit that subscribe button for the SAP Simplified YouTube channel. It really is the best way to support this work, and it costs you nothing. And of course, if you found value in this breakdown, a quick tap on the like button goes a long way. It tells the YouTube algorithm that this is good content, helping other people who are searching for the same information to find this video more easily. Your engagement makes a real difference. Thanks again for listening, and I'll catch you in the next one. Peace.